If your business partner died tomorrow, what happens? Not to their family, to your business. Who owns their half? Can you afford to buy it? Do you even have the right to?
The deceased partner shares do not disappear. Those shares are a real asset with real value. They pass to the estate of the deceased.
And kind of coming back to the spouse, do you come across situations where the spouse wants to be involved in the business?
That would never happen. Well, it can happen, but the spouse does not want to be in the business, doesn't want to run the business, doesn't understand the business. They simply want what's owed to them, which is liquidity.
Welcome to the Tax Blind Spot, presented by Dundas Wealth. I'm Martin Ochwat. Here's a question I've been asking business owners. If your business partner died tomorrow, what happens? Not to their family, to your business. Who owns their half? Can you afford to buy it? Do you even have the right to? Most business owners I talk to don't have an answer. Or worse, they have an answer they think is right, but often isn't. Today, I'm sitting down with Ben Corriveau. Ben is a licensed insurance advisor and partner at Founders Wealth in Toronto. He works with business owners across Canada, and this exact scenario, what happens when a partner dies, is something he deals with regularly. Ben, thanks for being here.
Thanks, Martin.
Ben, can you give the audience a quick version about yourself? What do you do and who do you typically work with?
Sure. Yeah. My name is Ben Corriveau. I'm a partner at a firm called Founders Wealth here in Toronto. At Founders Wealth, we work specifically with Canadian business owners and incorporated professionals for general financial planning and wealth preservation.
Great. Now let's start with the scenario. We have two partners. They own a business together 50-50. Say one of them passes away. Walk me through what happens next.
Yeah. So if there's no funded plan in place, here's what happens. The deceased partner shares do not disappear. Those shares are a real asset with real value. So like any other asset that person owns, they're going to be transferred over to an estate, likely controlled by the deceased partner's spouse. So at the same time, when this happens, the surviving partner just doesn't lose the co-founder, may experience a drop in revenue, bank covenants may be triggered, employees could be nervous. Essentially, there's a bigger issue that's been created. And if it's not addressed early on, it can lead to significant financial stress within that company.
Got it. Got it. And now what about the spouse? If a partner has a spouse, I assume they might not have any idea of how the business works. Do they now own half of the company?
Yes, unless there's a structure that prevents it. Like I said, the shares, they're an asset. So they pass to the estate of the deceased. So if we have a company where that's a 50-50 ownership, there's still a share that exists. That surviving business partner doesn't have an automatic right to those shares, doesn't absorb them. There has to be a structure to move that share back into the company, back into the hands of the surviving shareholder.
Right. And what usually happens in the situation, kind of coming back to the spouse? Do you come across situations where the spouse wants to be involved in the business?
No, that would never happen. Well, it can happen, but I'd say 99% of the time, the spouse does not want to be in the business, doesn't want to run the business, doesn't understand the business. They simply want what's owed to them, which is liquidity. So if it's not a clear path to liquidity, it can create tension immediately between the spouse and the surviving shareholder of that company.
It. Yeah, so I guess without a proper plan, even though the business might be healthy and profitable, it could essentially collapse or have some hardships because of the situation.
Absolutely. Yeah.
Okay.
Yeah.
Great. And so kind of going out a bit, I know a lot of business partnerships, they have some sort of agreement, maybe a shareholders agreement or a partnership agreement. Would that cover this situation where one of the partners passes?
Yeah. So when you're going through the process of, let's say, incorporation, working with a lawyer, there can be a boilerplate agreement put in place. It can be a detailed agreement put in place. But essentially, what that agreement is saying is what should happen in a scenario. It doesn't necessarily say how it happens. And how it happens requires funding. It requires money, right? Because the share has a value to it and that share needs to be paid for. So unless the company's sitting on cash reserves, which is rare, they need a mode to complete this transaction. So again, just because there's an agreement in place, that's great, that's legal. However, if there's no money to move it, nothing's going to happen. So I'll say to them, if I'm sitting down, we say, okay, sure, this is in place, but where is the money? Without the money, it's going to be through a loan. So if the same scenario happens and the transaction needs to be taken place, a loan needs to be taken, which is very expensive. Assets need to be sold, which isn't ideal. New investors need to come on board, which again might not be the right position for that company. So what we do is we help create the necessary funding.
So really the partnership agreement, it's just is it just a piece of paper without any funding behind it?
Yeah, unless there's funding attached, it's just a legal intention of what should happen.
Okay. And I guess in your experience, how common is this? What percentage of partnerships that you've talked to actually have a funded plan in place?
So if you've gone through the process of incorporating, there likely is something. It might not be right, but there might be something in the shareholder agreement, a valuation clause. And simply, as funny as it sounds, it's good intentions that everyone thinks they have early on in this, where he's saying, oh, we're all friendly, we all know each other, no one's going to have any issues if something happens. However, until it does happen, that's when the real values float up and they need to be addressed. So I'd say usually there might be something. Rarely is there the funding in place that we're talking about. So usually there's something legally put down, but very, very rarely is there an actual funding mechanism involved.
Okay. So a lot of businesses do have some sort of agreement. Most are lacking the funding, and I guess a lot of them are just one bad day away from having a potential crisis.
Yes. Yeah. And if they do have something, it might be too small. The other one that comes up is if it's when people think of talking life insurance, that they have personal insurance, therefore they're protected within the business. But in reality, there has to be something within that company before to provide this type of transaction.
I see. So now, how do you actually go about solving this? I know you mentioned insurance. Like, does insurance fund a buy-sell agreement? Walk me through how you'd actually solve this.
Yeah, insurance does create the most cost effective, most tax efficient structure to do a transaction like this. If we're in this scenario where it's 50-50 ownership, partner A, partner B passes away, and now we have a spouse that owns this share. If insurance is involved, the insurance would pay to the corporation, which provides the necessary liquidity to complete the transaction. So when we do sit down, we'll have the discussion and figure out the adequate amount, which involves understanding what that business valuation is, current and projected. And we find life insurance policy, if there's two partners, two life insurance policies that are owned and paid for by the corporation. And again, if we are in the scenario where a buy-sell clause is enacted, the insurance provides that necessary funding.
Would the insurance also take care of the family of the deceased partner in this situation?
Yes, yeah, and quickly tax efficiently as well. So if you think of it, two insurance policies, life insurance policies on the lives of the business owners. If there's a payment benefit being paid into the corporation, that money is now intended to be given to the family of the deceased to compensate for that share. So now the family's made whole through the payment, and the business owner, the remaining business owner, retains 100% control of that company. There's no additional unneeded stress within that company. Employees are relaxed. Other debt obligations aren't called into, and the business can continue as it's intended.
Interesting. And so, okay, let's say, I have a business, we have a partnership agreement, we want to get it funded. How would you go about figuring out the right amount of coverage? And how do you actually value the business for this purpose?
Yeah, so we'll work along with, like, if there's an accountant there, we'll work along with the accountant to figure out the exact current business valuation, which is just a mixture of earnings and assets on hand, as well as growth trajectory, and the ownership percentages that are there. So the example that we're using, it's very common, a 50-50 ownership structure. To keep the numbers nice and round, if it's worth $1 million and we're trying to create funding for that, 50-50 ownership, there would be two life insurance policies for $500,000 each, creating the necessary coverage.
And what does this actually cost? Like, say, I don't know, you have a 50-year-old business owner, and you mentioned the business is worth $1 million, so each partner needs about half a million, I'm guessing, in term coverage. Like, could you give me a ballpark of how you would calculate the cost for something like this?
Yeah. So we would run the numbers based on the age of the individual. A lot of people do assume that the costs are much higher than they actually are. One thing I always say, this is a fraction of what it would be to obtain funding in a period like this. So for a 50-year-old, for a $500,000 policy, you'd be looking at about $140 a month for the necessary coverage, which again is significantly lower than trying to obtain a $500,000 loan last minute to provide the transaction.
Right. So I guess what you're saying is for the cost of a gym membership, you could potentially avoid a six-figure problem down the line.
Yeah, no, it's in the grand scheme of things, absolutely.
All right. And now, what about the tax side of things? In Canada, how is this situation treated?
Yeah, so in Canada, there are very few financial tools that move money tax free, and life insurance is one of them. So there's many tax advantages to structuring it this way. But essentially, because we have the company owning and paying for a policy, if a death benefit does pay out, that benefit is tax free to the company. So if we're using the $500,000 in the same example, $500,000 is deposited into that company without tax. And now we have the next step of the transaction, which is trying to move money out. As any business owner knows, moving money out of a corporation is a bit of a nightmare in terms of tax. But in this case, we have what's called a credit to the capital dividend account. And that credit allows the money now to be transferred to the spouse to receive money for compensation for the share. As long as it was structured properly, again, no tax coming in and no tax going out. So it's just a tax-free transaction from start to finish.
Okay. And I guess for anyone who's not familiar with the capital dividend account or CDA, could you explain that in a couple of sentences?
Yeah, essentially what the capital dividend account does is so as money is deposited from an insurance transaction, it's a credit. It's an accounting, it's a notional account for the transaction to go through. So the money is now inside of that corporation, which allows, so if we use the example here, so $500,000 goes into the corporation, 500,000 is credited to the capital dividend account, and a capital dividend is not taxed. So money is now removed from the corporation completely tax-free.
Okay. So it's like it lets money go into the corporation and then come out without having to pay additional like income or dividend tax on that money.
Correct. If any business owner is aware of dividends, they know that they're paying tax on those dividends. The capital dividend account is completely separate, where it does not involve tax. So from that transaction, that allows the money to flow through the corporation tax-free, all because we created the credit through the deposit of life insurance.
That's powerful. And we're going to do a whole episode on the CDA later, especially when it comes to Canadian tax planning. And I know a lot of business owners haven't heard of it, so stay tuned for that. Now, Ben, what's the difference between, say, a cross purchase agreement and an entity purchase agreement when it comes to buy sell funding? And does it really matter what type of agreement you go with?
Yeah, so we'll work with the lawyer or the existing agreement that's in place to figure out the best method of structuring the life insurance policies. But yeah, they can be owned. Let's say the two partners can own insurance on each other. So the cross method where so partner A owns a policy on partner B owns a policy on partner A, and provide the necessary funds to the surviving partner if something was to happen to the other. Or we can structure it simply as where the corporation owns the policy on each shareholder, and then the corporation is going to receive the funding and then complete the transaction based on that. So it depends on how your buy sell is drawn up, will be how we design the best necessary funding method.
Okay, so it does depend a lot on the business situation, the partners, the corporate structure, and all of that. Is this something a business owner should figure out on their own, or do they need an advisor to help with this?
Yes, yeah, they do need an advisor to one, figure out the correct value that the policy should be, and two, working with an advisor to figure out the best structure of that policy. Because, like I say, it's very tax efficient as long as it's structured properly. And by going through the proper steps with us, we can ensure that it is set up properly from the very start, take an hour to figure it out and you don't have to think about it ever again.
Right. So now let's zoom out for a second. Say I'm a business owner and I just realized I need buy sell funding. What else should I be looking at that I'm also probably missing, perhaps even on the insurance side?
Yep, yep. So when we're doing our, let's call it a review with the client, one of the things that we do go through is the buy sell. Is it there and is it funded? The second part of it is key person insurance. It's something that is also overlooked quite often. And this doesn't necessarily have to be insurance on the shareholders themselves. This could be an individual within the company that is extremely important piece to that company. Again, key person. So without that person around, that business is going to suffer significantly. The example I use quite often is the number one sales producer within the company. Let's say if we have one person making up 60% of sales for that company, that's significant revenue. Without that person, any business owner knows that they're in pretty big trouble in the short term if that person was no longer around. Same concept, using life insurance to replace the financial impact that they would have, keeps everything stress-free within the business and allows it to continue on while they have the, let's say, the runway to sort things out.
Got it. Yeah, key person insurance. I can definitely see the value there, especially if you have important employees or personnel that would have an impact for you or your business. Are there any other types of insurance a business owner should be considering?
Yeah, and there's business overhead, but also, and that has to do with, because we can come across a scenario where disability comes into question, right? So it's easy to consider death, the certainty of it, and the definition of it. However, disability does get to a bit more complex in terms of the severity of it. Are they able to return to work? Does it trigger the buy sell? But example I use day to day is the proverbial bus comes by, and we can understand what happens if we pass away. But what about the scenario where we're faced with a significant disability and the business partner is no longer able to perform the duties that they once were? Does that trigger a buy sell? And if it does trigger the buy sell, how is that going to be funded? So again, instead of life insurance, we can look at disability insurance to provide the same type of funding just through a disability policy.
Right. And we don't like to think about it, but the chance of having a disability occur in your lifetime, I'd say, is much higher than a lot of people expect.
Yeah, I think 4 times for the average working age. So it's something that usually is more overlooked than the life insurance, but it's something that we do need to address and just simply understand the risk that's there. And are we able to provide insurance as a means to cover that risk?
Great. Now, what about the solo business owner watching this who maybe doesn't have a partner? Is this episode or anything we mentioned on the insurance side still relevant to them?
Yes. A business owner, especially if it's an incorporated business, they have a share attached to it. That share has tax attached to it. They have assets within the company. And also they have, let's say, an obligation to continue the company past them. So if it's a intergenerational type of business where you intend to have, let's say, a child take over that company, if you were to pass away prematurely, there's significant concern issues created by that. And insurance is a very tax efficient way to provide necessary liquidity to pay for taxes that might arise through the estate and to allow that business to continue.
Yeah, no, that's a great point, especially thinking about succession planning and insurance playing a role in that. But again, that's a whole other conversation that we'll get into in a future episode. So yeah, I think we've covered buy-sell agreements and why they're important as a funding mechanism for business partnerships. Ben, could you walk me through a real situation? You don't necessarily have to name specific names, but where you sat down with some business partners and found this gap for them?
Yeah. Oh, happy to take it through, like start from finish. There was pretty recently, yeah, came across, we were working with two business partners that own and operate a company, been around for 14 years, have seen significant growth as of recently. And we're originally discussing corporate investments. That's why we were brought in. And a part of the process, we do ask these questions just to make sure that we're not missing anything and that the buy sell does come up. But yeah, so two partners in their 40s, business was valued at, I think, $3.8 million. And so that means it's 50-50 share. So just under $2 million each share, we'll call it. Going around initial discussions, this did come up. And it happens every time where they don't want to talk about it. They assume that they're covered. And in this case, even they had coverage, personal coverage in place, which is also really common to bring up. And no, I have insurance policies. We're fine. We don't need to talk about it. But in reality, those personal insurance policies were designed for something completely different. Those personal insurance policies were designed for covering personal debt and income replacement for the family. It doesn't actually do anything for the other shareholder of that business. So what we did was we uncovered the risk, and what that was, $1.8 million on each shareholder for immediately funding. So I asked them, where does $1.8 million come from if the owner passes away? And do you want to be business partners with their wife, their spouse? That's a no every single time. So all we did there was ran the numbers and created two term 20 insurance policies on each shareholder for a very low cost. I think it was under $200 for each policy. So we took care of a $2 million risk on each partner, guaranteed it for 20 years. And within those policies, it guaranteed a clean transaction that fit within their buy sell to provide the funding necessary to quickly pay the spouse and continue operating the business as normal.
Yeah, that's powerful. Again, for the cost of a gym membership, they're able to cover that. But I'm also curious, when you initially showed them that number, the moment you said, hey, you're each going to be liable for $1.8 million, what type of reaction do you usually get then?
Usually when we are able to show it, and you can't argue with a number when it's there, it's sort of confusion because, again, most would assume that this has been taken care of with these legal documents. And then it's relief once the solution is not complicated. Not addressing it is extremely complicated. And I want to basically make that point of, once we're there, we can solve it within an hour. And then when you compare it to what happens without, no one wants to be in that scenario. So understanding that it can be addressed for a very low cost, for a guaranteed amount, for a guaranteed time period, is a huge relief for any business owner.
That is powerful. And I guess for someone who's watching this episode and thinking, okay, I have the same problem, I don't have it sorted out, what's the very first thing that they should do?
Yeah, get in touch. And it's going to involve pulling out your shareholder agreement, reviewing that shareholder agreement, discussing if there are any insurance policies in place and how are those being used, and reach out to someone like myself. Happy to talk. Like I said, it doesn't take very long to figure these numbers out. We just have to have an honest conversation to really understand where you are in the business, what you intend to do in that business. And if we are addressed with a scenario of a partner is no longer here, what are the expectations of the surviving business partner to continue that business?
Yeah. And what should they look for in an advisor when coming with this situation? I know not every insurance broker might even understand the business side of things.
Yeah, I would say that, working with an advisor that has experience specific to corporate structures and working with business owners is key there. If you have somebody that's working day to day for the personal insurance side of things, that's one thing. But what we're doing here is we're adding another layer of complexity within the corporations, but working with an advisor that has experience working with business owners, we can cut through that, we can clarify, and we can know exactly what's needed in order to continue.
And if someone's watching this today and they wanted to get in touch with you, Ben, personally, what would be the best way they could do that?
Yeah, happy. Yeah, like I said, my firm's Founders Wealth in Toronto. Simple Google. My email is ben@founderswealth.ca. Our website is founderswealth.ca.
Perfect. Ben, thank you so much. This was a conversation I think a lot of business owners need to have, but often keep putting off. And really, here's the takeaway. If you have a business partner, the question isn't if something will happen, it's whether your business will survive when it does. And while a shareholders agreement is great, without funding, it is words on paper. It's really the insurance that turns it into a plan that actually works. So if you want to check out whether your business has this gap, reach out to Ben. You can also click the link below, book a strategy call with our team, and we'll put you in touch with Ben or the right individuals who can help you with this. Once again, this is the Tax Blind Spot presented by Dundas Wealth. New episode coming in a few weeks. Subscribe so that you don't miss the next one, and we'll see you next time.